Howdy, Jacob here. Today we're looking at Columbia Sportswear Company in the textiles, apparel, and luxury goods industry. 4.8 billion market cap on 4.1 billion enterprise value, founded in 1938. So it looks like they're an unlevered company, or at least have a lot more cash in hand than debt. Growth is actually pretty impressive, a bit more than I would have thought for the business that I believe them to be. The classic jacket wearing company. I guess they do a lot of other accessories and apparel, but I know that's how I would think about them. 2.1 billion in 2014 to 3.5 billion in 2023. So that's about 4 to 6% compound annual growth rate on the revenue, with increasing gross margin and relatively flat operating margin. It went up a little bit in 2021 and 2022, back down to what it was in 2014. They do pay a dividend. It's a lot higher than what it was 10 years ago, over double, but it is still inconsequential in relation to their earnings per share. So the payout is fine with a very good return on invested capital, double digits. Gotta love that. Very likely above the weighted average cost of capital, creating business. Balance sheet shows 764 million cash-like products with no short-term debt and no long-term debt. Love that. Very safe investment from a balance sheet perspective. The company, I've said it before, it's extraordinarily difficult for a company to go under if they don't have debt, have a heavy amount of cash, and produce positive free cash flow. And here we see in the last 10 years, the only year they didn't make free cash flow was 2022. Outside of that, they have very heavy and healthy amounts of free cash flow being produced, with their use of their cash really being reinvestments and or investments, share repurchases, and a dividend that pays out a 1.5% yield, but that payout is not substantial, probably about 20 to 25% of their 5-year average free cash flow. So really not a big deal for the dividend payout. And, they invest a bit, a lot of share repurchases here. So on the revenue growth side, I think that we will be able to see maybe a little bit above inflation with their investments, but beyond that, probably not too much more. I think with their ability to reinvest at high rates gives them the market average P and price free cash flow, even though their growth is likely below market average. With margins in the, let's do 9 and 8, a little bit of a range. Buying back 1% of shares is about 48 million. So if they were to buy back 50 mil, 150, 174, that's 3%. 174 million in relation to, let's say, 280, 300 million is a lot, but they've bought back a heavy amount of shares given capital allocation in the past, and that's, I don't mind them doing that. Dividend, have they increased that? I'm sure they reduced it from COVID, but haven't increased that in 2 years, so I'm fine keeping that the same, even though the payout is only 20, 25%. I'm fine with them focusing their capital allocation on share reduction, especially if prices get lower from here. I want them to be buying back as many shares as possible with capital. And right now, Dream needs to drop 40%. I could see this being a decent investment at this point. I mean, we have got a company that's not going anywhere. I think I'm definitely not making any frothy assumptions here. And I think their capital allocation is really focused on giving money back to shareholders through dividends, share repurchases, and then reinvesting in capabilities that will hopefully grow their revenue and margins down the line. So I do think this is an interesting company, and I hope you enjoy the video and have a great rest of your day. Thank you.